Be nice to me. It's my first one of these that I've done. So, and thank you very much for your time. So Action Hotels is a company that I've been working with closely for a number of years. I used to be actually the investment banker that led the IPO back in 2013. And we raised the 50 million from institutional investors. I love the company so much, and they invited me to join to manage all their public affairs, being a public company. And so I've done that. I'm also acting CFO, while we're in between CFO. I'm a chartered accountant and know the business and financials inside out. So, so happy to do that. So it listed December 2013. We're currently a market cap of about 89 million, with a share price about 61p. Institutionally backed. Our major shareholder has 64% of the shares, and I'll go into more detail about that in a second. But we've got Blakeney, who are a specialist London-based MENA fund. We have Legal & General, Schroders, JP Morgan, Hargreave Hale, so a lovely investor base. So what do we do and who are we? We're a little bit different and a little bit contrarian to normal hotel groups out there. And we don't really have any true comparables because we are being very contrarian, very different in a quite a new and expanding market. So we, our aim is to become the leading owner, developer and asset manager of branded economy and mid-scale hotels. And when I talk about economy and mid-scale, to you and me, it's 3- and 4-star hotels. So we're not talking about the 5-star luxury, we're talking about the 3-, 4-star. And think of them around sort of $100 a night type of accommodation. We're predominantly focused on the Middle East because the market dynamics out there for this type of hotel, the 3- and 4-star, and is fantastic, and very encouraging, and I'll get on to that. We do have we have a legacy hotel in Australia. We've just acquired another hotel, an airport one there, and we are building the largest ibis in Australasia with Accor. And again, I'll go into more details about why we are in Australia and our plans for Australia for the future. But most importantly, we don't have our own brand, nor do we want to have our own brand. We only bring in the leading hotel brands. So we're in an Accor hotel today. So we've got 7 out of 9 hotels with Accor in our group at the moment. And we partner with Premier Inn, Holiday Inn. The Tulip Inn is probably not one you probably recognise too familiarly, but it's big outside of Europe and part of a massive group. And the Mercure, and actually we're doing a Novotel as well. So I'm going to take you through, I just thought to give you an introduction, I'm going to take you through sort of our sort of 6 pillars of our investment case. And just to tell you a little bit more about what we do, as we are a little bit different. So let me start with the market. Our chairman and founder, Sheikh Mubarak al-Sabah, he is a ruling member of the, he's a member of the ruling family of Kuwait, a young guy, late 30s, not the sort of sheikh you probably imagine and you see driving around Harrods in the summer in their Ferraris, but he is a proper business guy, Cambridge educated, Sandhurst, but he's very, very business orientated. I can't get over how he reads everything. He's highly intelligent, and it's all about coming up with ideas really to prove himself in the global markets. So he saw a gap in the market back in 2006, where he saw there was a real demand for 3- and 4-star branded hotels. There were at the time a number of unbranded 3- and 4-star hotels, but they're pretty basic, you don't know what you're going to get. You know, the middle class are coming through in the Middle East. You've got more people with more disposable income. You've got a huge young population coming through. 60% of the population is under the age of 30. You've got increasing travel within the region. So you've got the airports all increasing their capacity. You've got more airlines. You've got all the low-cost airlines now in the Middle East, which you didn't have 5-10 years ago. They're growing at 35% per annum. And obviously, because we are in sort of more challenging times, the corporates are reducing their corporate budgets. They're not letting their staff go and spend, you know, $200, $300, $400 a night on a hotel room. For their middle management, you know, they're looking at the $100 a mark, and I'll go into that a bit more in a minute. But so we're targeting we're not targeting tourists. So we're not targeting people in this room. We are targeting the people that work and live in the region. So we're targeting the middle management professionals, the KPMG accountant, manager levels, the lawyers, engineers. We're targeting leisure travellers. Well, there's a lot of business we have out of Saudi, literally people flying over into Bahrain and into Kuwait to go to the cinema, for example, and religious travellers going into Saudi Arabia and various other places. So the demand is growing, and it continues to grow. And the next slide is the supply. So when you talk about the Middle East, and probably many of you have been to the Middle East, you think about the image comes of the 5-star luxury hotels, and that is the case. It's all the blue is are 4-star and 5-star and above. So we are the current supply of hotels across the Middle East is predominantly in the luxury and upscale. So you're talking about your Hiltons, you're talking about your Four Seasons, you're talking about your Sheratons. Down in this area is where we're operating, and predominantly in the green area, which I don't know whether it's coming out too well in yours, but the tiny bit at the bottom is the 3-star hotels. So we've got there's a huge undersupply in the market, and these are for this year, for next year, and going forward. You can see the announced pipeline of hotels that are under development or due to be developed within the Middle East are pretty much non-existent when it's going out there. They're all to do with egos, and as Sheikh Mubarak's, it's a little bit cheesy, but his favourite line is, we're not looking for return on ego, we're return on equity. So that's the market. So really undersupplied, with a growing demand that's only going to increase. We are not a new company. We're not an early stage. We are established, and we're in aggressive growth phase. We've got 8 operational hotels which are trading strongly. We've got an average occupancy across the portfolio of our 9 hotels at the moment of 77%, which is fantastic when we break even at 35% occupancy. Because we're only doing 3- and 4-star hotels, you haven't got people handing out towels in the spa, you haven't got lots of room service, you haven't got loads of staff in the hotel, which you would expect of a 5-star. So we are able to make our hotels break even at 35% occupancy. 7 out of our 8 of our hotels were profitable in their first month of trading. This is because matching the low break-evency point along with the brands drive the traffic. So we could run our own hotels. You know, it's not rocket science to run a hotel, but what we use the brands for is their marketing muscle, their marketing machine, their loyalty schemes, their websites, their booking systems, their sort of technology platforms. So that's what we use the brands for. They operate the hotels on a day-to-day basis, but we push them to do that. So 7 out of the hotels were profitable in the first month of trading. We normally get about 40% occupancy on the first month of opening from any hotel. So the The one that didn't took 3 months, because that was the first ever 3-star hotel that had ever opened in Amman. So that took a little bit longer. But the relationships we have with the leading brands are excellent. We are on senior level contact with them. I was in Kuwait with Sheikh Mubarak. Obviously, he is very sort of well-known and high-ranking ruling family member over there. We were at his house with the chairman of Accor and the rest of the board, having dinner and discussing how we were working forward on more hotel projects. So the board as well, as you can see. So this is Sheikh here. So young guy. Alan is our CEO. He's based over in Dubai. He sends his apologies tonight. And you'll see that we're opening 2 hotels before the end of the year. So and so he's in Australia doing that at the moment. We're opening a big hotel in Australia. Raymond Shigo is a man worth noting. He was responsible for bringing Hilton to Europe and the Middle East. He is an extremely experienced hotel operator. He's quite vicious, even though he looks quite friendly on there. And he's fantastic with getting hotels open and troubleshooting. We've got 2 sort of city and strategic guys, and we've got Rawaf, who is one of the top architects in the region. So very well known, very good team. So this is what we've done since IPO. We've delivered everything we said we would do. We've opened more rooms on time and on budget, bringing our revenue up. We've added more rooms to the pipeline without coming back to the market and asking for more money. So value being added all the time, and an increase in our net asset value as we complete the developments. And as you see, this was as at the end of last year. We're nearly at the end of 2015. So this figure is going to be substantially increased when we report in early in the new year. So our partnerships with the brands, as you can see, and I think I've mentioned them, so I won't go too much onto this, but we're with all the big brands. Why are the brands wanting to work with us? They have, through the years, gone away from actually wanting to own their own hotels and are doing an asset-light approach. Accor, IHG, Premier Inn are a little bit different because they own their own, but all the main hotel operators, they don't want to own their hotels anymore, and they want to have either franchise agreements or management agreements in place. In the Middle East, also they can't own, even if they did want to own, unless they were doing it with a Middle Eastern partner because of the 51% ownership restrictions. So they've seen this gap in the market in the 3-4-star segment. They've seen we are the market leader doing it across the region. And because of our networks and because of our contacts, we are seen as the go-to people for these brands to get exposure to the Middle East. So what we do is we will find a plot, we will find a project or an existing building that needs converting. We will then put out to tender to the brands. They literally do all follow themselves, trying to get in their tenders to us. And then we choose the best deal and the best brand for that location. So we do that right at the start of the project. And this is how we work with them. It's not a franchise agreement. And we don't simply build it and hand over the key. So what we do is active asset management. So as I said, we find the opportunity, we do all the planning, design, in liaison, obviously, with the brand we have chosen, and spec it out to their requirements. Once the hotel's pretty much built and ready. Action Hotels will approve all the key hires, the general manager, the senior finance team. We will approve all the budgets, so they can't say that we want to open with 500 staff, which they normally come in with and want to do, and we'll tell them you can open with 50 staff. So, you know, it's not, they do not have a free rein on running these hotels. All the costs, all the revenues accrue to Action Hotels. All the staff are on our payroll, but they manage the hotels on a day-to-day basis. So they do all the day-to-day work. What they get in return for that is a percentage of revenue and profit, which, if we are talking on an average figure, will equates to about 10 to 12% of revenue. But it is on a revenue, and so they're incentivized to perform. Management agreements are typically 10 to 20 years, so nice and long, and you'll see when we come on to some of our other slides that we're completely in the time limits and lots of time to go with those. So opportunity for high growth and high return. So, as I said, the demand continues to grow. Action Hotels is the first mover in this region. The oil price volatility, we get asked all the time, and I think may have been reflected in the share price not performing fantastically over this year. People think the oil price has been, you know, detrimental to Action Hotels. They think people are not staying in hotels, but it's been very advantageous to us. People are grading down, people are choosing to not spend so much on hotel rooms. There is still the travel. The governments are all incentivizing non-oil sector. So all the other sectors, financial, leisure, are being backed up by the government. So there's plenty of people traveling within the region, and the oil price has definitely not been something that's hit us. We've got 8 hotels in the pipeline. These are all fully funded. We don't need to come and ask for any more money to the market. We've got another 2 to be opened by the end of this year. One in Ras Al Khaimah with the Tulip Inn brand, and the big Ibis in Brisbane on Casino Square. So they'll be completed this year with openings very early next year. And then we've got another 5 next year. So we are in deep development and growth phase. And remember, you know, these are easy to build hotels. We're not talking fancy hotels. We're talking basic, comfortable, affordable quality, but they don't have fancy spas and gyms and everything like that. So they're quick to build. We don't just do freehold properties. In some cases, there may be a property that we like. It may be not able to be separated. For example, it might be on the side of a mall or a different building where we're not able to take the full lease, to take the full freehold, or we may not want to own it in that country, or we do leaseholds. They, as we break even very quickly in the first month, on average, you know, the quicker we can get open, they obviously take less time. We might convert them instead of waiting for them to be built. So on that side, on the return side, we've got 8 new hotels, break even in the first month, so really quick profitability. And because we are working with the brands, the operators, and really pushing them when they're not performing to our expectations, to our budgets, we're able to really drive strong operating margins across all our hotels. So as I said, we don't just let them get on with it. We really do push them. We are developing the pipeline, so we're expecting some substantial growth on the NAV side. Yes, we do have debt. secured on, as you would normally see on development of assets. But you know, we get the development profit uplifts from, and we've had a really good track record of getting good profits on our completed hotel projects. We are dividend paying. We pay a dividend twice a year, even though we are in deep development phase. Our current yield's just under 4%, and will be, I think our dividend is due for payment at the end of this month, with the final one to be announced next year. So we're asset-backed because of our connections, because of our, how am I doing? Right. Because of our connections, because of our contacts within the region, we are able to get 5-star locations for our 3- and 4-star hotels. We're asset-backed, NAV of 190, independent valuations by Jones Lang LaSalle and CBRE on an annual basis. This is just to give you an idea of the properties, of some of our properties. Here's our Holiday Inn, which is our only 4-star. They are a lot nicer than what you would expect from an Ibis Holiday Inn in Europe. The Middle East does demand a higher quality. That's Premier Inn we've just opened. So our operating hotels, we've got just over 1,500 rooms. Here's the pipeline. As I said, we're fully funded and due for, so that it will take us to 3,000 rooms, just under 3,000 rooms by 2017, and our objective is to get to 5,000 rooms by 2020. So we're still in growth phase. We've got a bit to do, but we are firmly on our way. So our objectives really are just to keep focused, delivering our pipeline of hotels on time and on budget, and that's something that the team are highly experienced and been very good at doing. Pushing our existing hotels and coming up with new opportunities. So really just to finish, you know, we think and we believe, and obviously I believe especially, the combination we have of all the macroeconomics, the conditions in the market, the asset back, the high growth, is a very attractive one. So be nice with me on the questions.
I'll start off some questions, I'll be gentle. I think 87% of your properties are freehold, so you're more of a property player than a hotel operator.
Yeah.
Quite a big discount to net asset value at 26% discount, and you've got a yield of 3.1 and a progressive dividend, I think, it was 2.1 pence the last year,
yeah,
up from 0.76. So combination of a drop of net asset value and quite a high dividend payment. What's the catch?
There's no catch. I think the market has not responded to our growth. I think it takes time. I was a banker, I was a broker, I know it takes time to educate the market. And you know, that does take a couple of years to, especially with a different story. You know, we're not talking about a UK or Europe. This is a different story and a different play. I also think the market has not appreciated that the oil price volatility has been advantageous to us, not detrimental. But yes, we are trading at a discount to NAV. We are a dividend-paying stock, and we've just delivered and delivered growth and done everything that we said we would.
And will your dividend be higher? You know the numbers. It's only a month away. Will the dividend, do you think, declaration be higher then?
Yeah, I mean, we plan to do a slight progressive dividend while we're in growth phase. I expect, and the broker forecast look for quite a nice uptick in that sort of progression in the dividend from 2017 onwards. Okay. So the next 2 years, pretty stable, but just with some small growth. And that's really to reward our shareholders or thank our shareholders, even though we are in growth phase, to say we are in growth, but we do have a very cash generative operational side to our hotels. So we'll give you a bit of that while you wait for us to really play out the full growth.
Okay, Katie. Questions, anybody? Gentleman just here.
Why Australia?
Oh yes, sorry, I didn't answer that. So Australia was opportunistic. Sheikh Mubarak has global real estate all over. Australia is one of his big areas. When he approached Accor and IHG to bring 3- and 4-star hotels to the Middle East back in 2006, they wanted to work, Accor in particular wanted to work with him on a hotel in Australia on a plot of land he owned. They did that. It's been highly successful. It's a bit of a cash cow. It's in Glen Waverley. It breaks even at 20% occupancy. And it's something that we've left in the portfolio. We got the option to buy an already profitable airport hotel, which are very hard to come by. So we've just done that. We paid $8.8 million US dollars, and that will instantly adds another 70 odd rooms and another $1 million to our EBITDA straight away. So we got that at a very attractive price, and airport hotels are a bit of a gold dust when you find them. And we were persuaded again by Accor to do their biggest Ibis hotel in Australasia on Brisbane Square, again some land that we owned. So Australia is there. It's there for now. Is it our core focus? No, the Middle East is, because the market is so exciting in the Middle East, and it's really where we know and operate and want to invest in. But it provides a little bit of more leverage. It provides a little bit more on the seasonality side. When it's hot in the Middle East and probably too hot to travel in Ramadan, it's very busy in Australia. So it's providing some smoothing, especially on the seasonality side. So at the moment, Australia is in there. Maybe that's something that will be looked at in time. But at the moment, it's a nice part of the business and just a very stable market.
Any more questions?
You indicated on the slides that there were, I think, 2 hotels to complete at the end of this year, another 5 next year.
Yeah.
Can you talk a little bit about what can be expected after that?
So let's just, oh no, I'm not on my thing anymore. So after that, we have another, so that takes us to 7. So we've got another 1 hotel coming. That's it, thank you. So we've got the healthcare city in Dubai and the Staybridge in Abu Dhabi coming after that. As I said, we want to get to 5,000 rooms by 2020. So we're in discussions, constantly in discussions over other projects, whether they'll be on a freehold or a leasehold basis or a mixture. But we are in growth mode, and we're definitely targeting that 5,000 rooms.
First mover advantage in the 3- and 4-star hotels.
Yeah.
Can you talk a little bit about as to whether there actually is a competitive threat coming through? Are people trying to emulate what you have done?
Not really. The market is very large, and the demand significantly. There's a lot of play for in the market. What happens in some of the regions is you get local owners doing 1 or 2 hotels, which they then will do an agreement with one of the brands we're saying. But we're the only ones doing it across the region, and that's what the brand's like. No one else is doing this. The Middle East culture, it's all, as I was saying, it's all a bit of an ego. It's all about who can build the bigger and the better hotel. We're not doing that. We're very contrarian to that, and so.
Gentlemen to the right, then to the left. Oh, to the right, then to the left. Yeah.
You mentioned something about in the Middle East it's impossible to 100% for a foreigner to operate. So there's a 50% rule. How does your company fit in with that? I understand your major shareholder being a local and so on, but the shareholders of the company presumably are the owners of the company. So how does that work?
So at the point of IPO and we were shadowing a couple of other successful Middle Eastern IPOs, Al Noor, MNC Health, where ownership structures have been put in place to allow for an ownership. So we have a Jersey company. It has A and B shares. One has the economic rights, one has the voting rights, and it's structured in a way that will allow foreign ownership. It's been tried, tested, hence our very sort of hefty IPO costs from our lawyers. But it's something that's we're one of the first people to do it, not the first, but it's we have found a way to get around that.
Gentlemen.
Hi, yeah, you mentioned that His Highness is interested in return on equity,
Yeah.
but I haven't actually heard what that return is or
So
what it should be. So could you just illuminate us on what sort of returns the business is making?
So the returns or the forecasts? So did you want some idea on?
The current returns would be good.
So on the return side, the profit numbers.
Is it making a 10% return on the equity employed in the business, or
Oh, okay.
15%? Or
Well, it differs on project to project. On the freehold side, you're talking about a 15% return. On the leasehold side, it can be a little bit higher because there's obviously not so much cost involved. But we're expecting our forecast to more than double. So our EBITDA, our broker Investec are putting our EBITDA at 15 million this year. By 2017, they're estimating that we'll be at 30. So you're looking at a double of EBITDA between now and the end of 2017, and that's purely on the basis that we've got so many hotels coming and opening. And then you've obviously got your returns on the NAV side. We'll have some significant NAV growth coming through there as we obtain the development uplifts, especially on the big hotel in Australia that's coming through.
Chris, final question over there.
Sorry, an awkward question, Katie. Looking at the list up there, 357 or 67 rooms in Australia.
Yeah,
It's about a quarter of the rooms.
yeah.
And you're saying you get a margin of 20%, a break-even point 20%.
We do on the existing legacy hotel we have. I expect the IBIS will be slightly higher in Brisbane to start with,
So your overall break-even is 35%, you say.
across the portfolio.
So in the Middle East, it must be a lot higher than that.
It's only higher on the leaseholds because there's the lease element, the rental element that has to be paid, and that takes that a little bit higher. But the break-even, the numbers speak for themselves, and the
So probably the break-even points in the Middle East probably more than 40%.
only on the leasehold.
Right, okay.
Yeah.
I've got one last. You say you're fully funded. How are you fully funding the build? Are you doing it through debt, through cash,
So
or
it's through a mixture. We raised 50 million at the IPO, so we've still got some of that in the bank. As I said, we get secured debt on the properties and on the projects that we do. And obviously we've got 9 hotels that are generating free cash flow of over 10 million this year. So we use that as well. So we don't need, for everything that all the pipeline hotels up there, we don't need to come back.
So you're not coming back to the market for more money yet?
Not at the moment, but
No.
you know, as I said, this takes us to 3,000 rooms.
Okay.
We want to get to 5,000, and you know, we do want to use the markets at some point.
Okay. Thank you very much, Katie. Thank you.